Hello, everyone. Welcome back to Navellier Market Buzz, episode 16. I'm Crystal Navellier, and I'm joined again this week with my father, Louis Navellier. Dad, I'd love for you to start out talking about what do you expect from the retail sales report on Tuesday?
Well, it's supposed to be up 0.4%, but when you exclude auto sales, it's only supposed to be up 0.1%. And frankly, I think consumers are spending a little bit more than that. So I'm looking for a surprise. It should help lift the market. And But from what I can tell, consumers are out and about spending.
So then why are auto sales so strong?
Specials, they had too much inventory, lease deals, special financing, all that stuff. They're just trying to unload their inventory. It's really bad at Jeep Chrysler, but it's bad everywhere. If you want a Cybertruck, it's 999 a month to lease. If you want a Hummer, it's a pickup. It's 849 a month to lease. I mean, these are just examples of what they're doing to move products that are stuck on dealer lots.
So obviously the big news on Wednesday would be the Fed interest rate cut, the Federal Open Market Committee statement, and also the new dot plot. What do you expect from all of that?
Well, we're expecting the Fed to cut rates 25 basis points, quarter point. The other thing is we expect a fairly dovish FOMC statement, but they might hint that they might not be cutting next meeting. And then finally, the dot plot is really the most important thing. It surveys all 17 Federal Open Market Committee members, and we'll get a feel for how many rate cuts they expect in 2025. What's so fascinating is that last week, Bloomberg did a survey of folks in Europe, and they came back with that they're going to cut rates to 2%, but some economists in Europe are expecting they're going to cut rates to 1.75. So right now, the European Central Bank, after their cut last week, is at 3. So we have 4 to 5 rate cuts in Europe, largely because they have a recession. Germany's definitely in recession. France is in recession. Those are two largest economies, and they both have political chaos, and France, can't get a budget through. He has to get a new prime minister, and then, of course, in Germany, they're going to have a new election. But in Europe, they don't have the inflation we have because our inflation is largely housing related. And then guess what? They're getting old and they're dying, and their number of households are shrinking, so they have extra real estate. So we're different than Europe. Our inflation is almost all real estate related. Now, it was 0.3% owner's equivalent rent, which was it's under control. We'll get a better feel on the PCE comes out a week from Friday, but it's very interesting. I think that we're gonna have a lot more rate cuts next year than we think, largely because Europe and other economies are gonna be slashing rates, and it'll force our rates to just meander lower. But I'm not sure we'll see it on the Fed's dot plot. So the dot plot will give us insight into maybe 4 or 5 months, but I think we have a 12-month outlook. We have a lot more rate cuts.
Now, can you give us more insight on the PCE index that'll be announced on Friday?
Sure. Well, it has less owner's equivalent rent than the CPI, so it hopefully will be at 0.2% or less. Though I saw one of my favorite economists is estimate 0.13. So that would be good if it came in at that level. They round off to to 0.1 or zero point 0.2. Um, but that is important. If we just throw out real estate, we're at 2% inflation in the Fed's target. I think the main comment I have is that our inflation is food related now, and we saw it in the CPI and the PPI, and it was largely soaring egg prices because the bird flu, but on the wholesale level was up over 54%. So thank God we have those two chicken stocks.
Can you remind everyone what those are again?
That's Calmine, CALM, and Vital Farms, VITL. So Calmine is the biggest egg producer in the country. The chickens are crammed in hen houses. It's not the best life, okay? Vital Farms has organic chickens. They're running around having a much better life. And so if you like organic eggs, you have to pay a little more. but your chicken was a lot happier.
So speaking of stocks, our subscribers wanted to know what your thoughts were on ALAR, SEZL, and also any updates on SMCI.
Sure, I was happy with ALAR's earnings. There seems to be some always confusion with ALAR over operating versus their basic earnings, but ALAR keeps hitting record earnings, the and sales. Now, Cancord, which is a brokerage firm that follows it, did lower their price target to 25 from 28. So according to Cancord, it should still double. So I'm holding ALAR. This is an Israeli tech firm. Israeli stocks are very thin. They get acquired a lot. Obviously, Israel's got a lot of their employees are part of the IDF, and they have other things to do. But ALAR is a great stock, and I'm going to continue to hold it. Super Micro SMCI was very strong earlier in the week. Their chairman was out and about speaking, talking about how they're still on track to build everything in Malaysia. And the JP Morgan analyst was interviewed, and she said they're still getting all the orders. They're not getting order cancellations because they've been in the news with a short seller and the accountant resigning, but of course they have a new accountant now. And so Supermicro early in the week was little stronger. Unfortunately, it was announced late in the week. They will be bumping the NASDAQ 100 later this month. So that means it's going to lose a little mojo here. But I'm holding Supermicro for a variety of reasons. One, it still has incredibly strong forecast sales and earnings, stronger than Nvidia. Dell has not become a formidable competitor. HP is doing a little bit better. So when we get into the water-cooled server farms, they use the fast NVIDIA chips. Supermicro is the company. In fact, our friend that does artificial intelligence chips in Boise, he raves about Supermicro, the data centers. So I'm going to keep holding the stock, but when it gets bumped from the Nasdaq 100 later in the month, it will have a that will not be its best day. I'll put it that way. And then finally, SEZL. SEZL's on track to have phenomenal sales and earnings growth. I'm not worried about it at all. We got a very strong analyst upgrades on that stock. So that's definitely one of our favorites and obviously one of our biggest winners this year.
Kind of switching topics, why is indexing so popular?
Well, that's interesting. I think it's easy. I think it is tax efficient. I'm originally from Berkeley, and I was taught that we're all supposed to index for social peace and harmony. But you're showing a couple of graphs that are very interesting. And before we get into those graphs, I just want to clarify. If you're going to index, do it in a mutual fund. Don't do it in an ETF. So if you want to index with a Vanguard fund or another low price fund, that's fine. But what we're now showing you is what happens when you index with an ETF. So the first thing we're showing you is SPY, and that's the S&P 500 ETF since inception. And you can see that if you bought it at the close and sold at the opening, you make a lot of money. On the other hand, if you bought it at the opening and sold it at the close every day, you barely make any money. So when you buy an ETF, there's something called a spread. And you can go to morningstar.com and check what the spread is. And I recommend you do that on every single ETF trade. And if the spread, is 2 or 3 cents, great, go ahead. If the spread's $2, you're getting fleeced. So we're showing you reports from Bespoke, which show you, again, index performance based on ETFs during market hours, after market hours. The one that's the most interesting is the QQQ index, the NASDAQ 100. And there you can see that if you bought at the opening and you sold at the close, since inception, you actually lose over 50% of your money. On the other hand, if you bought at the close and sold at the opening, you make a lot of money, even more than the index went up. You might have heard that there's some professionals on Wall Street that are pretty smart. And this is kind of what's going on. Some very smart people will trade aftermarket. They will trade at favorable prices. You just can't go blindly buy an index because if you're not careful, you could get hurt. And that's why we're showing you those bespoke charts. So, indexing is like anything in life. If you know what you're doing, it'd be great. If you don't, you could get hurt. Okay. But I'm definitely anti-indexing. I publish all my research in the public domain via our stock grader. Our A's do better than our B's, which do better than the C's, D's, and F's. And our whole philosophy is to have you not index. But some people just don't care. They don't take any time. The media loves to mock uh, active managers that don't beat the indices. But it's funny when they quote the indices, they don't show the costs. And what those bespoke charts are showing you, there's real life costs if you start to index with ETFs. So ETFs have incredible popularity. And the main reason they have such popularity, and I had my own ETF for a while, is that in addition to getting a management fee, you can get a piece of the spread. So they get to double dip and get paid twice. And some of these ETF firms, as money's coming and going, they can make more money on the spreads than they do on the actual management fees. Probably the best example of that were the pod ETFs. Over a decade ago, if you went to Yahoo Finance, they'd have these little ads saying, the pot billionaires are becoming pot billionaires. And so you click on this little Yahoo link and it'll give you a little story and stuff. But they could take your information if you filled out to see the article, and they'd sell your name to an ETF firm. And if you bought their ETF, you literally got fleeced 20% that day because they bought a lot of the pod ETFs are in thinly traded Canadian stocks. So that's what we're trying to educate people on, that you just can't blindly invest all the time. And you got to be really careful and you got to check the spreads. But with that said, ETFs are fine if you know how to trade them and you don't get fleeced on the spreads. But the fact that SPY and QQQ have such dramatically different performance uh, uh, based on when and how you buy is shocking to most people. And this is why I sold my management business in 2013. I sold a broker-dealer arm because we were systematically being denied best execution by some platforms. So we sold the business, didn't want anything to do with these firms anymore. And we consolidate our business at Schwab, and we love Schwab. And that's where we have most of the client money now.
Well, finally, I'd love to ask you, what are your favorite A-rated stocks right now?
I still love Costco. They announced last week their sales, as we kind of warned you guys, weren't quite as strong, largely due to the gasoline sales. As gas prices come down, their sales drop. But they had a 6.3% earnings surprise. They were selling a lot of vegetables and food. So people are definitely eating more at home, not going out less. Their Kirkland brand is sales are booming. That's their generic brand. They even have Kirkland golf clubs, believe it or not. So we're ecstatic with Costco. Okay. And it's a phenomenal buy. We still love Navellier. Their sales are forecasted to be up 72% next quarter. Their earnings are only forecast to be up 64.9%, but I think Navellier will surprise. They're selling the Blackwell chip now. And then we have a new biotech company that we recommended in our newsletters recently called ADMA. It's ADM MA Biologics. They make plasma biologic treatments, and their sales are supposed to be up over 53%, and their earnings are supposed to be up over 307%. So, what we do this time of year is we fine tune our portfolios to get ready for the next round of quarterly earnings that are going to commence mid-January. And then we're going to enjoy another earnings announcement season. It's important to tell everybody that the S&P's earnings were up 8.4 last quarter, and that was the low. As we look at the fourth, first, and second quarters, the next three quarters, the S&P earnings are forecasted to be up well over 10%. So earnings are reaccelerating, and that's one of the reasons the market's so favorable. And we've also noticed the breadth and power of the market is getting better. It's not perfect. It's still a stock picker's market, but there's more stocks to pick from. So we're very excited, and we'll be especially excited after the Fed cut next week. We think that'll be the trigger to start a year-end rally. And uh, and traditionally we rally going into the holidays, and then in my opinion, the last chance for you to buy is the last week of December between Christmas and New Year's. And I will be doing some tax selling in for some people, but I will be also deploying a lot of cash that week because I expect us to gap up in January.
Perfect. Well, thank you for answering all my questions. And just so you all know, Lou is going to be in the Bloomberg studio Friday morning, December 20th. Thank you to you all again for liking and subscribing. Once again, if you have any questions, please leave them in the comments below. But until then, we'll see you next week.